Good morning, Bitcoiners. Hello, and welcome back once again to your Bitcoin economic calendar, the news and analysis you need to start the week off right in Bitcoin. I'm your host, Mauricio Di Bartolomeo, co-founder and chief strategy officer here at Ledn, and today is Tuesday, May 3rd. In today's issue, we wanted to spend some time breaking down and explaining some of the changes and trends in the markets that have led to the adjustments in the interest rates for both Bitcoin and USDC savings accounts. We're going to dive into some detail into what those trends are and why they are essentially leading to the changes that you are seeing. In addition to that, we're also going to talk about a highly anticipated Fed meeting, which kicks off today, and investors are expecting a 50 basis points interest rate hike as a result of today's meeting. That could impact markets. We're going to dive into how. And last but certainly not least, we're going to talk about institutional capital flows that have been essentially driving some of the growth we've been seeing recently on DeFi. So without further ado, grab your coffees, everyone. It's going to be a great one. And starting as we usually do with Bitcoin, here we're taking a look at Bitcoin's price performance over the last few weeks. We see that last week Bitcoin dropped by 2.48%. So far this week, Bitcoin has been holding quite resiliently considering the activity in the rest of the markets, particularly S&P 500 and capital markets in general. But we're seeing Bitcoin hold up down 60 basis points so far this week, down 2.48% from last week, and it's around essentially this important support level near its $37,000. We're going to get into some levels to watch towards the end of the episode. But for now, we also wanted to chat about our recent announcement for our interest rates for savings accounts for both Bitcoin and USDC as of May 1st. And again, going into some of the trends and changes in the markets that have led to some of these changes in the interest rates. So as we mentioned, or as you're probably aware of if you're a Ledn client, the interest rates as of May 1st for our savings accounts have been adjusted. The savings rates for Bitcoin in the first tier up to 0.1 Bitcoin will be 5.25% APY, and then balances above 0.1 Bitcoin will earn 2% APY. And on our USDC savings accounts, the interest rate will be 7.5% APY for all balances. So that's the rates for as of May 1st at the Ledn platform. And as I mentioned in the beginning or in the intro, we wanted to spend some time in today's piece to do a deep dive into what drives these interest rates for both Bitcoin and USDC savings accounts. As you know, changing market conditions for Bitcoin and digital assets have resulted in compressing interest rates for both Bitcoin and USDC savings accounts in the recent months. So as always here at Ledn, we like to be transparent and upfront with our client, readers, and viewers about the market forces that are driving these changes. So today we're going to do just that. We're going to do an overview of what these use cases are and what are the changes that have been occurring leading to these adjustments. So let's start with Bitcoin. Today we're going to cover two main use cases or trades that institutions use borrowed Bitcoin or USDC for. And these use cases that we're going to cover are all outside of decentralized finance schemes. So let's start first with market neutral trades. And for that, we're going to pop up our one of our charts here to illustrate what makes these trades possible and what are the mechanics for these particular trades. So the first trade we're going to cover is market neutral trades. And the main trade opportunity in this camp of market neutral trades is the futures basis trade. We've covered this trade here before, but we want to review it one more time in today's issue and just highlight what has changed in this trade opportunity over the last 6 to 12 months and even shorter term. Like there's been quite a few material changes, as you will see, even as recently as the last 90 and 30 days for these market opportunities. So for one, let's start with the futures basis trade. This trade is essentially, this trade works when the price for Bitcoin contracts for future delivery trade at a higher price than spot price. And that is reflected in this futures curve today. Given the market conditions today, we are seeing that the future dates here for June or in July are seeing some flatness, and this is due to the expectation that investors have for what that future price of Bitcoin will be in those months. But suffice to say that when, in most cases, Bitcoin futures markets trade in a contango, which means, as you can see here in this curve, you can see it in this Deribit curve quite well, that essentially the price for June delivery is trading higher than the price for today, which is the spot price is 38,225. The price for June is 38,276. So again, when the future price of Bitcoin is trading at a higher price than spot, you can then there's an opportunity for an investor to take advantage of this futures basis trade. And to take advantage of this trade, what an investor will do is they will essentially buy Bitcoin at today's value. So let's use a hypothetical example and assume that Bitcoin's at $35,000. An investor could then buy Bitcoin today at $35,000 and sell a contract to deliver that Bitcoin in 3 months for $35,250. So if I buy at $35,000 today and I sell for delivery in 3 months at $35,250, I would then be able to pocket the $250 difference between the time that I'm buying it now and the price at which I am delivering in 3 months' time. So by buying the spot Bitcoin and holding it until delivery, you can make $250 on your $35,000 investment of that first Bitcoin that you bought. So this means that the implied yield on this trade would be $250 divided by $35,000, which was your original investment. This works out to 0.7%. And this is a 3-month term that you're getting this 0.7% for. So in order to annualize this yield, we must multiply this 0.7% times 4, since an investor could perform this trade 4 times in a year, in a calendar year. And so therefore, the implied annual yield on this hypothetical opportunity of buying Bitcoin at $35,000 and selling it at $35,250 in 3 months' time would be 2.8%. That is the implied yield on this hypothetical trade. Now let's take a look at a more concrete example, because Skew, this platform here, allows us to see the already calculated implied yield on the 1-month and 3-month futures contracts for Bitcoin across different venues. So let's look at that. I have them at the top here. So we're going to highlight the Chicago Mercantile Exchange, and this is on a 1-month chart. So here, by looking at a 1-month chart, and this is the 1-month contract out for Bitcoin in the Chicago Mercantile Exchange, which is the safest of all venues, which is the most highly regulated venue in the United States that has access to Bitcoin futures. So as you can see from this chart, the implied yield on this 1-month contract futures basis trade has compressed quite dramatically throughout the month of April. As you can see, at the start of the month, almost a month ago, it was trading at about 5.62% in implied yield. Then it compressed dramatically to go into the negatives to the tune of negative 16%. And yes, an implied yield can be negative. What this means is that the future price for the contract of Bitcoin is trading below the price of purchasing the Bitcoin on the spot market today. And that would result in a negative yield. Now, as you can see, this yield has essentially hovered at around 0. It's essentially 0 today. And this is what has happened to the implied returns of this future basis trade on the 1-month contract. Let's look now at the 3-month contract, again on the CME. So as you can see, the chart on the 3-month futures basis trade paints a very similar picture. It went from a high of about 5%, call it at the beginning of the month, to the current 1.66%. In simple terms, the return on high quality market opportunities, market neutral opportunities, has compressed. This, in turn, forces the institutions that are participating in these market opportunities to have to lower their cost of borrowing, meaning they can afford to pay a lower interest rate for their borrowed assets. This results in lenders like Ledn having to lower the interest rates that they can charge to institutional borrowers, and therefore having to lower the interest rate that we can pay to our savings clients in both Bitcoin and USDC. So this is what's happened to this futures basis trade, this market neutral trade bucket of opportunities. And so as these returns have compressed, as I mentioned, they have led to the associated changes. But let's take a look at another big use case for which institutions borrow Bitcoin for, which is market making. And this is essentially arbitraging the price of Bitcoin across different exchanges. This is another form of market neutral opportunity for which institutions borrow Bitcoin for, and this is commonly referred to as making markets or make markets across different exchanges. Because Bitcoin has no central price at which you can buy and sell Bitcoin, this price of Bitcoin varies across different exchanges, sometimes greatly. And this variability across Bitcoin prices in the same time across different exchanges can create opportunities. To take advantage of the small price differences that Bitcoin may have across different exchanges, institutions borrow large amounts of both dollars and Bitcoin to fund accounts across different exchanges. And then they wait for the right opportunity to see discrepancies in prices so they can action on both exchanges and capture that small difference. A hypothetical trade in this world would be to buy Bitcoin at $30,000 on Coinbase and immediately at the same time sell one Bitcoin at Kraken for $30,050. And therefore you would be making $50 on the spot by buying at 30 and selling at 30,050 in a different exchange at the same time. Then you have to rebalance your balances at the different exchanges, but you get to pocket that difference. And you can do this many times over and earn an implied return on percentage terms on the assets that you are using across the different exchanges. So as more market makers enter exchanges and compete, the gap between the bid and the ask prices for these exchanges compresses because there are more now market makers trying to get narrower and narrower and narrower, and they are doing this across multiple exchanges. And so what ends up happening is that most bid-ask spreads across high-quality exchanges end up getting compressed as a result of competition between market makers. So let's take a look at the average spread across different exchanges, because this can allow us to see what's been happening in this world. And in here, what you have on this chart is the average buy-sell spread on a $1 million order in both Coinbase and FTX. That's just examples of different exchanges, but this trend has been true across many of them, if not all. And as you can see, the average spread on a $1 million order for both Coinbase and FTX has compressed quite dramatically over the last 3 months. It has essentially halved from 0.17% to the current 0.10, 0.9%. So it's basically half of what it was over the last, or at the start of February. So again, this shows you that the competition among market makers is heating up, and more compressed spreads essentially mean less opportunities for arbitrage, or tighter opportunities for arbitrage, and therefore lower returns on those types of strategies. Now, to layer on top of this, another issue, or not issue, but another point to highlight how competitive market making has been getting, the volume, the aggregate volume that is being traded on the spot markets in Bitcoin is also trending lower. So you're seeing tighter spreads on lower volume, which just highlights how much more competitive the market making business is getting. And so again, in simple terms, this means that market makers are also seeing their average returns get compressed, which forces them to have to lower their borrowing costs. And then lenders like Ledn have to reduce the rates that they charge to their institutional clients, which translates into having to offer lower rates to clients that are looking to earn interest in the savings accounts. And so again, this is kind of showing you how these changes flow through to different participants in the industry. So moving away for a second from these forces and these market trends that are driving these interest rates, we want to look at the week ahead for Bitcoin and what we can expect. So as we mentioned during the intro, investors seem to be expecting a big move or big announcement from the Fed this week, with a 99% probability of a 50 basis points hike in tomorrow's decision. So just to summarize, the Federal Reserve is meeting today, and they will issue a decision by tomorrow on the interest rates for the U.S. markets. Again, investors are pricing a 99% probability of a 50 basis points hike, and equity markets have since broken the lows from earlier in March, namely the S&P 500 and the Nasdaq. As you can see, they've broken. These were the lows from February and March, and as you can see, yesterday and today, or so far this week, they've already broken those key levels from March. Now, interestingly, Bitcoin has been performing quite resiliently in this environment, as we covered last week. And just to highlight today, Bitcoin still has not broke its lows from earlier in the year, which again is a sign of resilience. Looking at some of the market structure in the derivative world for Bitcoin as we head into this very busy week, we see some healthy signs. And one of these signs is, as we showed, is most of the futures curves continue to remain in contango, which again means investors are pricing Bitcoin in the future higher than today, which again, when markets are getting aggressively bearish, it's not uncommon to see the future contracts for Bitcoin prices trade below spot prices. So again, these are signs of health. We are seeing some backwardation on the curve. Here is the Kraken curve that's showing some backwardation, but by and large, most others are looking pretty healthy. Another interesting sign is the perpetual swaps funding rates. These have been squarely in positive territory as of the start of the week. FTX essentially stopped being negative yesterday, and Deribit has not even gone negative all throughout the last week. So again, this means that in other words, what this means is that leveraged investors are not excessively leveraged to the short side. In fact, they are lightly leveraged to the upside, which means that there is no sort of expectation in the leveraged investor community of a big drop in Bitcoin. At least they're not positioned for it as per the funding rates that we're seeing in the perpetual future swaps. And this is also consistent with the short interest for Bitcoin on Bitfinex, which is a common sort of trigger that we look at. And we see that the short interest on Bitfinex remains eerily low. It hasn't even broken the highs of earlier in the year, which again is a pretty healthy sign as we go into a week that's supposed to be quite turbulent. So that was quite a bit to cover. We're going to get into now what's ahead for the week and a few more details to expect. And as always, we wrap up with what is ahead for the week. As we mentioned, this will be an important week for investors, mostly or mainly because of that big decision that has been coming, or that should be coming out of the Fed by tomorrow. And Jerome Powell's press conference tomorrow will certainly be an interesting one for investors to essentially look into the tea leaves of, in addition to the potential 50 basis points hike, what other additional new plans the Fed may highlight. In terms of price levels to watch for Bitcoin, if Bitcoin and most markets continue under pressure, given the Fed's big campaign to tame down asset prices, a key level to watch if Bitcoin continues trending downwards would be MicroStrategy's average purchase price for their Bitcoin holdings. And that number is currently sitting at $30,700. Institutions will likely look to defend this price level, including Mr. Saylor, if they see an opportunity to do so. A lot of institutions would love a chance to add Bitcoin to their portfolios at Saylor prices. So we'll keep you in the loop of any developments right here on the economic calendar and through our social media throughout the week. So as we mentioned, the big piece of news coming out this week is tomorrow's FOMC statement. The Fed's decision comes out at 2 p.m. tomorrow, and we get a press conference from Jerome Powell at 2:30 p.m. Eastern tomorrow. There's also non-farm payrolls and unemployment data that comes out on Thursday at 8:30 a.m. and Friday at 8:30 a.m. But again, these would probably take a second stage to whatever decision the Fed makes on tomorrow's press conference. So with that, we've reached the end of today's show. If you enjoyed it, if you learned something, I welcome you to thumbs up it, like it, subscribe to our channel, share with your friends. And if you don't yet have a Ledn account, I welcome you to check out ledn.io where you can earn the best interest rates for your Bitcoin and USDC savings. We also have the best rates on dollar loans backed by Bitcoin if you need liquidity but don't want to sell your Bitcoin. And our most recent product, the Bitcoin Mortgage, lets you buy a house as big as your stack. Learn more at ledn.io. Thank you, everybody. Have a wonderful week and see you next week.